Hi there and welcome to the Moneyman Show. I'm making this video today because I believe we are in a very pivotal point of the markets. Before I begin my analysis, I would like to remind you that you are welcome to my site, themoneymanshow.com, where I log my trades, and you have a page where you can have live quotes from very different instruments. Leisure page where you can have stuff for your free time, and a search page where you can have all the three bigger search engines and some usual stuff that we do, the social part, the email part, and world news, finance news. So just check it out if you like it. About the analysis, this is the SPY, it's the ETF of the S&P 500, and then this is the low of 2009, and this is the high of 2007. Okay, so as you can see here, we have a clear three wave, 1, 2, 3 wave. Okay, as what it is for me, a big one wave. Okay, one wave, and this would be the second wave, where you have first wave, second wave. So here it's the low, first low inside, second low, and this is the third high. If you draw a parallel line from this one to this one, these lows here are not by accident in these positions. Okay, you will see why. If you put a parallel line from the first low, since this low, it's this one, bang, here, the first time it really makes a low, you have here the first one, the second one, like clockwork, right? 1, 2, and here the same. First time that this makes a low is here, but this one is lower, so you put it here. As you can see, put the line from this one to this one, copy it, parallel line, and bang. This is where you should buy it. You would have already made $5. Okay, and these ones are where you should buy it, 1 and 2. Perfect timing. So about the position of the market right now, as you can see, this first wave is smaller than the second wave, and when this happens, it usually means that there will be a third wave, meaning that will break through this the high of the second, and it did. But the third wave was smaller than the second wave, which means that if it broke down from this high right here, it would mean that would go lower, and it did. So for the markets to go higher from here, meaning that the first wave should be smaller than the second wave, and the second wave should be smaller than the third wave. That would mean that market would follow through and go up a little bit more. It didn't, and it made a correction. Right now we have a first wave from the second big one, and this one is bigger than the second wave, which means that the market here is weaker. So I don't know if we will have the third wave. Okay, it should have been bigger. This one should have been bigger than this one, and it's not. If you see, it didn't reach the half. Should have been bigger, this one, and it isn't. Also Also, a very important technical analysis that I use is the Fibonacci, and if you put the retracements of the high and the low, you will see that we have just touched the 75% correction from the drop. Okay, this is where we reached. The exact point is almost by 50 cents difference. Okay, and why is this 25% important? Well, you will see in the first here, in the first wave, I can pinpoint almost exactly this high and this high and this high just by the retracements from the Fibonacci. So I'll put from the low to here, it's the first high. Okay, what will happen? Sorry, from the first big high is this one. Here, because it's where it's the lower and the higher, and you'll see 75%, bang, and it dropped to the near to the 50%. Okay, and this was the first high. Okay, and if I continue from the low to this second high here, bang, I get the second high right here. Okay, from this one. So this is the bigger one and this is the second, and if I put here, I will probably get this one, right? It didn't reach, and that would mean that it's weaker also. So you have a confirmation from this one to this one. Here it reached the 75%, here it reached the 75% and dropped a little bit, and dropped a little bit. Here it didn't reach the 75%, dropped a lot more. Okay, so you have this one plus the length of the run is lower than this one. You have a combination of indicators, and that makes your judgment much more stronger. Okay, so here we have the 75% of the big drop, and also we have this run is smaller than this one. So I would be careful right now, especially because Friday it made a kind of a cross. This is indecision points. Okay, so I would expect the market to probably gap a little bit on Monday, and if it goes up and breaks these highs and continues to break this high also, I would be much more confident in the continuation of the bull run. However, if it goes down, you will also have another significant indication for the drop, and that would be a divergence from the stochastic. You will see right now the stochastic is already higher in this point than it was in this point. Okay, so if this drops and the blue line drop below the red line, you would have the confirmation of the divergence, and the minimum target will be this one. But I would project a much probable downside that would lead us to this place right here. Okay, so be careful, let the market play in this 2 days of the week, the first 2 days of the week, and this is what I wanted to show you. Okay, if you have any questions, feel free to send me an email to themoneymainshow@gmail.com.